Hello everyone, this is Jyoti. Today we will be starting about the topic Ind AS 101. That is first time adoption of the Ind AS. What happens in case if any company adopts the Ind AS for the first time? They would be required to make any various types of adjustments in their financial statements in order to uh, uh, keep the consistency in their financial statements. That is, earlier they were applying the AS accounting policy, that is accounting standards being followed under the gap. Now they would be preparing the FS as per the Ind AS, either mandatorily or voluntarily. Then, in case of the change in the accounting policy, they would be required to prepare the FS retrospectively, that is from the first day from which the company is being started. So, in such a case, every company or any of the company exactly, in generally also, any of the company, it's not like easy for any of the company to retrospectively apply the Ind AS to all of their financial statements. That is, if the company is being established since 1970, then it cannot prepare their financial statements for the last 50 years again. So they would be doing a few of the adjustments only that would be required in the transition. Basically, Ind AS 101 would be applied only for the first FS being prepared as per the Ind AS 101. And there are various of the key terms. That is, first Ind AS FS adopts the Ind AS, then have to comply with all the Ind AS. Partial compliance is not covered. They will be required, once the Ind AS are being applicable, they will be required to comply with all the Ind AS, and they would not be required. They would not be following with only a few of the Ind AS. They would be required to follow with all the Ind AS. Transition date: beginning from the period in which an entity presents the full comparative information under Ind AS FS. For example, preparing the FS for the financial year 18-19, then for the financial year 2018, along with the comparatives for the year 2017-18. Like, the company is preparing the financial statement for the financial year 2018-19, then they would be Ind AS would be applicable since 1st of April 2018. Along with that, they would be required to prepare their comparatives for the immediately preceding financial year, that is for the financial year 1st of April 2017 to 31st of March 2018. Previous gap accounting policies used for statutory reporting in India. Earlier, the statutory reporting that were being used in India, they were the previous gap, that is the accounting policies. Even now it is being used, but Ind AS would be applicable on a few of the listed companies on which the Ind AS is applicable. Every company would prepare their financial statements as per Ind AS after the following relaxations. Okay, that is they are as follows. That is either the recognizing, second one is derecognize, third is reclassify, fourth is apply Ind AS measurement. Now, first is the recognizing. All the assets and liabilities which would be required to be recognized under the Ind AS that were not being recognized under the AS. So they would be required to be recognized as under Ind AS. So it would have the effect on the financial statements. For example, in case of the bills discounted, if the bank is issuing the bills and the bills are being discounted, then under the AS the discounts were not being used to be recognized. Whereas in case of the Ind AS, it is required to be recognized as what do Ind AS think that in the future the discount would be recognized, would be taken as a liability, and they shall be recognized. So Ind AS requires the recognition of the bills discounted. It was for the example. So therefore, recognizing. Second one is de-recognize. The assets and liabilities of Ind AS does not permit such recognition. That is, the items which were required to be recognized under AS, they would and not required to be recognized and de-recognized, then in such a case, the Indies would say that the items would not be required to be recognized, that is, the items to be de-recognized. For example, in case of a proposed dividend, what do used to be happen under the AS? That is, if the financial year ends as on the 31st March and the proposed dividend have been declared as on the 30th of September 2000. Financial year ends on 1st of April 2018, and the proposed dividend have been proposed as on the 1st of October 2018. Fine. Then the financial statements have been prepared as on 31st of March 2018. Then in such a case, under the AS, the proposed dividend were used to be recognized, but and considered as a liability. But under the Ind AS, it do not require the requirement. Under the Ind AS, it do not require the recognition of the proposed dividend. So, Ind AS we will say that we could not recognize the proposed dividend as on the 31st March 2018, as the proposed dividend have been declared later on. So, these are the de-recognizing items. Third one is reclassify the items into the appropriate head as per Ind AS. Various items that are being recognized under different head under the AS, they would be required to be recognized under a different head under Ind AS. For example, the preference share capital. Preference share capital used to be considered as a shareholders fund under the AS, whereas under Ind AS it would be considered it could be considered as a liability. So there is a difference which is required to be considered and given effect thereto. Fourth one is apply Ind AS measurement principles for all assets and liabilities. Under Ind AS, the items are being recognized at the fair value. The most important point being considered over are ESOPs. Under the ESOPs, they are measured at a fair value. Basically, under Ind AS, it requires the measurement of the assets and liability as per the Ind AS. Under the transition, the companies would be required to give the effect retrospectively. So, there are a few of the relaxation that we have discussed just now. And the transitory relief. See, ऐसा हो सकता है, it could happen that either the company, in case of the transition, would apply the transition, the various differences. It could check the differences as in the between the AS and Ind AS and would give the effect thereto. Even the Ind AS says if you can't do the calculations from a very previous year, then do one thing. Either you if you cannot retrospectively restate the amount as per the Ind AS, then do one thing, take the deemed cost as on the date of the transition, that is substitute value which is permitted to be used under the Ind AS 101. Substituted value, that is different Ind AS that says the value that you could take under the Ind AS 101, that you are allowed to take under the respective Ind AS. Take those costs as the deemed cost and take the transition effect thereto. And if there are any differences, then transfer the same to the OCI or opening retained earnings. They would be considered as an equity. Those differences would not be charged to the P&L, that is profit and loss. Now, there are two types of exceptions, that is mandatory exceptions and optional exceptions. Optional exceptions are those exceptions in which Ind AS provides choices that you could either give effect to, or you could, if you want, you do not give the effect thereto. And the second one is mandatory exceptions, which are mandatory required to be given effect to under the Ind AS. There are various transitory items. First one we would be discussing about the ESOPs. ESOPs are the share-based payments share-based payments, that is being considered under the Ind AS 102. Ind AS 102 requires the ESOPs to be considered at a fair value only. However, as per the cap, it were being valued at intrinsic value. Under ESOPs would include two parts. First is about the vested options, second one is about unvested options. Vested options are like grant date is 1st of April 2016, vesting period is 3 years, and 1 year have been expired and Ind AS becomes applicable. Then in such case 2 years are remaining. Then as 1 year have already been passed, it means the options are being vested. And the second one is unvested options. Unvested options are like grant date is for the 1st April 2016, vesting period is 5 years, and none of the period have been vested, then it would be expired. Then in such a case it would be considered as an unvested options. See, the accounting policy for the statement in the accounting. First one is vested options. Vested options, either you could continue the previous cap value, like you have created a reserve, SBP reserve, under the you have created the reserves for the employee expense under the AS. Either you could continue those cap value under the Ind AS 2, or you could value the ESOPs at fair value. If the information for the fair value is available, then take the fair value as under the vested options for the treatment of the ESOPs. Or and the second one is about the unvested options. Under the unvested options, likely consider it as per the Ind AS 102 and take the fair value and take the fair value. Fine. Next one is about the foreign exchange that we used to have as a AS 11 under the accounting standards. Over here, the transitional adjustments are as follows. That is, in case of the foreign exchange items, let's see one thing first that used to happen under the AS. What we used to do under the AS is foreign gain or loss if we used to be occurred under the long-term loans, that is monetary items. Under AS 11 previous cap, we used to do as follows: that if we were having two options, like option 1, if we are having the forex gain or loss, then they used to be directly transferred to the P&L. And the same as this would be going to be happen under the Ind AS 21-2. However, if the forex gain or loss are like of very high amount and we are unable to recognize the same in just one financial year, as if we recognize the same in just one financial year, then that would be like going to greatly affect the same financial year. Then in such a case, if they are being considered as irrevocable, then we would be going to opt for the option 2. We that is that is being considered under the par 46 or 46A. See, if we would be having the general loan, it is being bifurcated into two parts, that is general loan or the depreciable asset. If there is a general loan, then such differences would be transferred to FCMDITA, that is foreign currency monetary item translation account, and such balance in FCMDITA, they would be required to be amortized over the loan tenure, that is the tenure of the loan. In the period of the tenure of the loan, such balance being under the FCMDITA would be required to be amortized. And or this was about the if you are considering it under the general loan. And the second one is in case of a depreciable asset. In case of a depreciable asset, transfer the differences to the PPE, that is the asset account, and such differences and such forex gain or loss would be adjusted to the depreciation. Okay, this was used to be considered under the AS11. Okay, now under the Ind AS, if you are having the foreign exchange items, then you would be having the two option, that is foreign currency translation reserve (FCTR). You could create a foreign currency translation reserve. If you would be having the foreign currency translation reserve under the AS, then 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 either you could convert the FCTR balance directly to the zero value and do the adjustment whatever for whatever the differences could occur due to the adjustment to the zero value. For resetting the value of the FCTR to the zero could be transferred to the retained earnings. Okay, or you could retrospectively apply Ind AS 21 since the financial year the company have got started. The second thing is about if you are having the forex gain or loss on long-term loans. Okay, then in such a case, if you are having the existing loans under option 2 para 4646A, that is in case of if we were having any irrevocable forex gain or loss, then we used to have apply the forex we used to apply by 4646A. Then you could either continue with the previous cap policy or apply the Ind AS 21 retrospectively, or if you are having if they were being applicable in case of the existing loans. Now if you're having the new loans or the loans where option 1 was taken that is if you are having new loans or the loans, then directly apply Ind AS 21. Don't think about the previous accounting policies that were used to being applied. If you're having a new loan, we would be taking the new accounting policies. We would be going on with the new accounting policy, accounting provisions. So apply directly the Ind AS 21. Okay, then the next one is about the PPE, intangible investment in subsidiary, associate, joint venture. That would be preparing the separate financial statements. PPE, intangible investment in subsidiary or associate or joint venture. In such a case, either you could apply the Ind AS retrospectively from the time the company have been started, or you could either retrospectively apply the Ind AS and do the adjustments and transfer the difference to the OCI or the retained earnings and accordingly do the adjustments to arrive at the point of the transition. Or you could directly take the deemed cost, that is deemed cost could be either the previous cap carrying value that used to be considered under the AS, or you could take the fair value. Okay, for the investment property, fair value option is not available. If you are having the investment property, then in such a case fair value option would not be considered. Either you could do the retrospectively applying the Ind AS, or you could take the previous cap carrying value. Second thing is, if in case of the investments in subsidiaries, associates and joint ventures, they can optionally be shown at a cost as the Ind AS 27, or do the valuation as per the Ind AS 109 as the case may be. बेसिकली जो पेरेंट कंपनी फॉलो करेगी वही फॉलो करना है. Okay, in case if any holding company is having the subsidiaries, associates or the joint venture, then in such a case either compute the cost as per the Ind AS 27 or follow the Ind AS 109 as the case may be. Whatever the parent company would apply the same. The same would be applied by the subsidiary, associates or the joint venture. Next one is compound financial statement instruments. Compound financial statements. In case if there is a liability component which is outstanding, then in case of as on the date of the transaction, Ind AS 101 requires the entity to follow the uh, to either split the existing convertible instrument into the liability and equity component. To split the convertible instrument amount into the liability and equity component. Okay. As on the transaction date, if your liability component is outstanding, then split the amount by computing the interest rate and by using that interest rate, splitting the amount of the liability component into the liability component and the equity component. Or you could do, or if the liability component is not outstanding as on the date of transaction, that is, it would occur after the transaction date, then in such a case, no need of doing the splitting of the liability component amount. So, the next one is about the business combinations. What is business combination? First is about what is business combination. See, remember, you would be remembering the AS14 amalgamation. What used to be happening with it. Two of the companies company used to be acquiring another company, or two companies are getting merged into one company, or the various examples of them that used to be followed under the AS14 amalgamation. The same topic is being considered under the business combination. If there is a business combination, then could do either of the following, that is, either no restatement for the past business combination, that is if the company have been amalgamated since 1990, then you could do either no restatement of the business, or and directly take the carrying value as as being considered under the previous cap policy, or restate the past business combinations with effect from either the starting or from the particular selected date. That is, like the business have been started since 1990, then you could either restate since 1990 or take some particular date, like 1st of July 2000, 1st of July 2000, say 11. Okay, do the restatement since 1st of July 2011. Okay, but the one thing is quite to be considered over here is that all the acquisitions since 1st of July 2011 are quite to be considered. We could not say that one of the acquisition that we are considering one of the acquisition in the restatement, and one of the acquisition we would not be able to consider. You would be mandatorily required to consider all the acquisitions since 1st of July 2011, that is from the particular selected date, or from the first point since the business have got started. Okay, now the next one is non-controlling interest. Non-controlling interest, that is, as we used to consider the minority interest under the AS. Minority interest, you would be remembering, like at the time of the consolidation of the financial statement, the holding company while acquiring this, while preparing their financial statement, used and often while preparing their consolidated financial statement, used to take the carry, used to have mentioned the minority interest in their financial statement. Same is over here as a non-controlling interest. Minority interest were used to being computed, were used to being taken either as a negative value, but under the Ind AS, non-controlling interest cannot be taken as a negative balance. In Ind AS, negative balance दिखा सकते हैं taking it under equity, Under the AS, negative balance could not being used to be taken. However, under the Ind AS, the negative balance could be taken. That is, however, it would be also could be taken as a we could take the non-controlling interest as a negative balance, but they are required to be taken as under the equity. So under the non-controlling interest NCI, you would be having choices. That is, one would be uh, you could either do no restatement of the past business combination and NCI at previous cap value, no restatement. That is, you could either take the previous cap value as it was there in the accounting policy and do not do the restatement of the business, or you would be having the second choice as do the restatement of past business combinations and NCI has to be restated. Okay, non-controlling interest is required to be restated retrospectively as per Ind AS. That is, first option was no required to do the restatement and NCI that we used to be carried on as under the gap. The same amount of NCI would be carried on, and or first choice was this, and the second choice is do the retrospective restatement of the non-controlling interest as per the Ind AS. Now, the next topic is investment and joint venture. Investment in joint venture. See, you would be remembering AS 27 joint venture, where the consolidation at the time of the consolidation there used to be the proportionate consolidation method. That is, the at the time of the consolidation, proportionate of all the assets and liabilities were used to be taken. However, under the Ind AS 28, the companies would be used to follow the equity method by taking the net assets as investment along with impairment. That is, after taking the total of the assets and reducing the total of the liabilities, whatever would be appearing, they would be considered as a net asset. And after that, the impairment is also required to be given effect there too. And whatever would be the balance, they would be taken as the investment. That is transition from proportionate consolidation to equity method. It would be done as follows. That is, aggregate carrying of all the assets and liabilities, including goodwill, that would be considered as an initial investment. And after taking the total of the investment, do the testing of the impairment there on too. Now, next one is government loans at below market rates. Government loans at below market rates. You would be remembering under the AS 12, if a company is taking the loans at an interest rate below the market rate, then there used to be no adjustment for those below interest rate than the market rate. The entry used to be being done as just as follows. That is, bank account debited to bank loan account. However, in Ind AS 20, we used to consider even those loans on which the interest rates are being uh, on which the bank loans are being given at a discounted interest rate. Then in such a case, such type of loans would also be required to be considered under the Ind AS 20 as a government grant, Then in such a case, whatever interest rate we would be having, by taking that interest rate, we would be taking out the present fair value of the total loan amount by taking the PV of the interest and the loan amount. And the entry would be as follows. That is, bank account debited to bank loan account to the grant account. That is, by the PV of the bank loan would be transferred to the bank loan account, and the difference would be transferred to the grant account. Okay. Now, the next one is, in case of a transition, what would be happening in case of a transition? Government loans. If we are having the government loans, either you could do the prospective application Continue to record the loan as a financial liability equity as per the previous cap value, and grant is not recognized for the benefit arising due to the below market rate of interest. Okay, in case of the prospective application, like we were following the gap under the AS, and now we are not changing this, retrospectively restating our financial statements and changing the previous gap accounting policy to the Ind AS accounting policy. Then just carry on the amount as there was in the gap, and there would be no requirement, and do not do the adjustment of the below market rate of interest carrying loan and prospective application, and prospectively apply the same policy that were used to being applied under the AS accounting policies. And the next one is we are retrospectively restating the financial statements, that is recognizing the grant and restate the loan if the information needed to retrospectively restate could be obtained based on the conditions at the time of the initial accounting of the loan. That is, we are taking the loan at that time, we are having the all information of all the conditions, like of the interest rate, of the loan amount, we are having all the information. Then in such a case we would recognize the same and apply the apply the Ind AS policies retrospectively. Okay, then the next one is measurement of the financial statement. Financial instruments. Measurement of financial instruments. In case of a financial instrument, uh, it would be considered under Ind AS 109. Okay, Ind AS 107, 32, and 109. Ind AS 107, Ind AS 32, and Ind AS 109. Everything would be discussed over there. For the timing, we would discuss about the transition provision. In case of a transition, if the EIR, that is effective interest rate, can be determined retrospectively, then in such a case retrospectively restate and determine the carrying value as per the Ind AS 109. Like if we could retrospectively restate the financial instrument, and retrospectively restate and compute the carrying value by applying the Ind AS 109. First option is this. Second option is if it is impracticable to determine the effective interest rate and restate the financial instruments value, then in such a case just take the fair value as on the date of a transition, and that would be considered as a carrying value. Okay, just take the carrying value, just take the fair value, and that would be considered as a carrying value. So as under AS, normal accounting would be done. That is, however, under the AS, what used to be done, we used to consider only the interest, premium, discount towards the P&L account. Under the Ind AS, we do the accounting by computing the effective interest rate at the fair value. We compute the amount and record the same. Next is estimate. You would be remembering the provision, contingent liabilities, and contingent assets. The same are over here. If we are preparing any type of the estimates, then in such a case we could follow the gap as we could either carry on the estimates that were used to be required under the by the previous gap, and if yes, if the same are being carried on, if there are any type of the values of the estimates as under the gap, just carry on them. If there is an evidence of error over there in the value being determined under the gap, if there is an error of evidence, then they make the estimate reflecting condition at the relevant date. If there is an error, then in such a case the estimate make the estimate reflecting condition at a relevant date. As on a relevant date, make the estimates. if as according to the conditions available. And if there is no evidence of error, then consistent with the Ind AS. And if you are consistent with the Ind AS, use the previous estimates. And if you are not consistent with the Ind AS, then use the previous estimates and adjust to reflect the Ind AS. That is, if you are not being able to do the consistency with the Ind AS, then do one thing. Whatever estimates were being carried on at earlier under the gap, just take them and do the adjustments for the following transitions according to the Ind AS, and do the adjustments accordingly. Okay, thank you.